And we just had some big news yesterday. We had a 25 basis point cut. You were starting to explain, and I hope you can now explain to us, because I know there's a lot of confusion for the normal layperson and the buyer. When they see that rate cut, they think that that's immediately affects mortgage rates, but that's not the case. It's tied to 10-year rates, and oftentimes the market projects what they anticipate is going to be a rate cut, and then that's kind of baked in. Is that kind of how it works, or can you explain to the layperson how it works?
Yeah, just to make it simple for a call today. So the Fed funds rate, um, when you hear that the Fed chairman spoke yesterday, that just means that the the Fed funds rate's going to decrease, and what they're going to do is whenever the banks borrow from the Federal Reserve to meet the reserve requirement, that's the Fed funds rate. But in terms for the consumer, how that affects it's auto loans, credit cards, and HELOCs because those are tied to prime, and prime follows the Fed funds rate. In terms of mortgage rates, I look at the 10-year Treasury yield. Whenever we see the 10-year Treasury yield um, increase, and normally we see an increase in mortgage rates. Okay, so there's more to that. And we also could talk about mortgage-backed securities, but I think that's a little bit more complex. So mortgages are bundled together by a bank and sold to the secondary market and are converted to mortgage-backed securities. And you and I, Eric, could invest into mortgage bonds, which are related to similar to what the 10-year government bonds are. So that's how, what we tend to follow, what drives mortgage rates. I mean, there's so much to it. But why the 10 years? Because most people that have a mortgage either sell or refinance within 7 to 10 years. So the 10 years is a good benchmark for mortgage rates. I don't, I'm hopefully this doesn't sound too complex.
No, that's good. And which mortgage products are performing the strongest for buyers that you're working with?